In September 1929, the stock market stood at a price-to-earnings ratio of 32. It then collapsed by 89%, wiping out $30 billion in wealth equivalent to $500 billion today. In October 2007, before the financial crisis, the S&P 500's P ratio was 27. It crashed by 57%, destroying $8 trillion in household wealth. But right now, in December 2025, the Shiller-Cape ratio stands at 40, higher than both previous crashes. Meanwhile, total U.S. debt has exploded to 719% of GDP, compared to 160% in 1929 and 350% in 2008. Corporate debt, household debt, and government debt are all simultaneously at record highs, while interest rates remain elevated at levels we haven't sustained in decades. What you're about to discover isn't conspiracy theory. It's mathematical reality. We're heading into what economists are calling the everything crash of 2026, where stocks, bonds, real estate, and even cryptocurrency could collapse together in a synchronized implosion that makes both 1929 and 2008 look like dress rehearsals. By the end of this video, you'll understand exactly why $50 trillion in global wealth could vanish, which warning signs are flashing red right now, and what you can do to protect yourself before it's too late. If you appreciate deep dives into the economic events that could reshape your financial future, the stories most people are sleeping through, please hit that like button and subscribe to this channel. And make sure you ring the notification bell, because the next 12 months could be the most critical financial period of your lifetime. Chapter 1. The Bubble Nobody Sees. Let's start with something Wall Street doesn't want you to understand. We're not in one bubble. We're in the largest everything bubble in human history. And the numbers prove it. The Shiller-Cape ratio, which measures stock prices against 10 years of inflation-adjusted earnings, currently sits at 40. That's a valuation level only exceeded twice in history, right before the 1929 crash when it hit 32, and during the dot-com bubble peak of 2000 when it reached 44. Both times, the market subsequently collapsed by over 50%. But here's what makes 2026 different and more dangerous. In 1929, the bubble was isolated to stocks. Most Americans didn't own equities. Real estate stayed relatively stable. Corporate debt was manageable at around 90% of GDP. When stocks crashed, it took time for the pain to spread through the economy. In 2008, the bubble centered on housing and mortgage-backed securities. Stock valuations were actually reasonable at a KP ratio of 27. Government debt stood at 67% of GDP. The Federal Reserve had room to cut interest rates from 5.25% down to 0. They could deploy quantitative easing because their balance sheet was clean. But today, everything is inflated simultaneously. Stock valuations, CAPE ratio of 40, meaning stocks would need to fall 50% just to reach historical average valuations of 20. Corporate debt, now sitting at 80% of GDP, with $1.3 trillion in junk-rated bonds that companies will struggle to refinance as rates remain elevated. Household debt. At 68% of GDP, Americans owe $17.9 trillion in mortgages, credit cards, student loans, and auto loans. That's $2.4 trillion more than in 2008. Government debt. Federal debt alone has exploded to 126% of GDP, $36.8 trillion total. In 1929, it was just 16% of GDP. In 2008, it was 67%. We've nearly doubled government debt in just 17 years. When you add it all together, total U.S. debt, government, corporate, and household combined equals 719% of GDP. Think about that number. For every dollar of goods and services America produces, we owe $7.19. In 1929, total debt was just 160% of GDP. In 2008, it was 350%. We've doubled the debt burden since the last crisis. This matters because debt is future consumption pulled into the present. Every dollar borrowed must eventually be repaid with interest. And right now, with interest rates at 5.5%, far above the 2% we got used to for over a decade, the cost of servicing all this debt is becoming unbearable. The Federal Reserve is trapped. If they cut rates to help debtors, inflation reignites. If they keep rates high, defaults cascade. Either path leads to the same destination: a crash that combines the stock market devastation of 1929 with the debt implosion of 2008. Except this time, there's no rescue possible. Chapter 2. Warning signs everywhere. The cracks are already appearing, and they're following a pattern eerily similar to both previous crashes, except they're happening faster and across more asset classes simultaneously. Start with the commercial real estate time bomb that's ticking louder each month. Office buildings in major cities are sitting at 20 to 30% vacancy rates because remote work permanently changed how America does business. These buildings were financed with cheap debt at 3 to 4% interest rates. Now that debt is rolling over at 7 to 8%, and the math doesn't work anymore. A building worth $100 million in 2021 might be worth $60 million today, but it still owes $80 million to the bank. Over $1.5 trillion in commercial real estate loans mature between 2025 and 2027. Banks are already starting to seize properties rather than refinance at a loss. Small and regional banks, the ones that hold most commercial real estate debt, are quietly building loan loss reserves and tightening lending standards. Remember, it was small banks failing that triggered the panic in both 1929 and 2008. Then there's the consumer spending illusion that's about to shatter. Credit card debt hit an all-time high of $1.14 trillion, and delinquency rates are climbing to levels not seen since 2010. The average credit card interest rate now exceeds 22%, the highest in 4 decades. Consumers kept spending by borrowing, but they're hitting their limits. Auto loan delinquencies are also spiking. Over 7 million Americans are more than 90 days behind on their car payments. That's a critical threshold because cars get repossessed at 90 days, forcing people to choose between losing their transportation to work or defaulting on other obligations. This is exactly the kind of cascading default pattern that preceded 2008. The yield curve has been inverted for months, meaning short-term interest rates exceeded long-term rates. This is one of the most reliable recession predictors in history. It inverted before the 1929 crash. It inverted before 2008. And it's inverted now. When it uninverts, when long rates shoot above short rates, that's typically when the recession actually begins. We're in that danger zone right now. Corporate earnings are also starting to miss expectations. Big tech companies that drove market gains are facing reality. The AI spending boom isn't generating the revenue growth they promised. Companies spent over $200 billion on AI infrastructure in 2024 to 2025, but concrete returns remain elusive. When the AI bubble pops in history, says all technology bubbles eventually pop, it will take the Magnificent Seven stocks down with it, and they represent nearly 30% of the S&P 500's total value. The warning signs aren't subtle. They're screaming. The only question is whether anyone is listening, or if we're collectively sleepwalking into 2026 the same way investors partied through September 1929 and summer 2007. Chapter 3. The triple trigger. So what actually causes the crash? Not one trigger, 3 simultaneous triggers that feed on each other in a vicious cycle the financial system can't survive. Trigger 1. The refinancing crisis. Between now and the end of 2026, $4.2 trillion in corporate debt needs to be refinanced. Companies borrowed heavily when rates were at 0. locking in 2 to 3% interest rates on bonds. Those bonds are maturing, and companies need to borrow again, but now rates are 6 to 7%. For a company with $1 billion in debt, that means annual interest payments jump from $20 million to $70 million. Many companies, especially in retail, manufacturing, and commercial real estate, don't generate enough profit to cover the new interest costs. They face a choice: default on the debt, slash costs by firing workers, or try to refinance at even worse terms. All three options shrink the economy. This is different from 2008, when the problem was mortgage debt held by consumers. This is corporate America, the employers, facing a debt wall. When companies start defaulting, unemployment spikes. When unemployment spikes, consumers can't pay their debts. And that's when Trigger 2 fires. Trigger 2. The consumer debt cascade. Consumers are already stretched thin with $17.9 trillion in debt. When layoffs begin, and they will as companies struggle with refinancing, millions of people will suddenly face the horrible math of modern America. They owe more than they earn. Credit card defaults spike first because those are unsecured debts. Then auto loans default because people need to keep housing. Finally, mortgage defaults begin because even housing can't be maintained without income. This cascade takes 6 to 12 months to unfold, but once it starts, it's unstoppable. Banks respond by tightening lending even further. Credit cards get canceled. Car loans get denied. Mortgage applications get rejected. This credit contraction means even people who still have jobs can't borrow, which freezes consumer spending, the engine that drives 70% of the U.S. economy. Trigger 3. The government paralysis. Here's the nightmare scenario that makes 2026 worse than 1929 or 2008. When the crisis hits, the government can't rescue anyone. Federal debt is already 126% of GDP and climbing. The government is spending $1.2 trillion per year just on interest payments, more than we spend on defense or Medicare. There's no room for another multi-trillion-dollar stimulus package without triggering a bond market crisis where investors refuse to buy U.S. debt or demand much higher interest rates. The Federal Reserve's balance sheet is still bloated from the last crisis. They can cut interest rates, but from 5.5% to what, 0 again? That didn't work long-term last time. And if they print trillions more on quantitative easing, the dollar could collapse and inflation could spiral out of control. We're out of bullets, out of rescue plans, out of time. Chapter 4. The $50 trillion wipeout. When these three triggers fire together, the mathematical result is catastrophic wealth destruction on a scale humanity has never experienced. Stocks, $25 trillion loss. U.S. stock markets are currently valued at approximately $50 trillion. With a CAPE ratio of 40, stocks are roughly 100% overvalued compared to the historical average of 20. A return to average valuations means a 50% decline. That's $25 trillion gone. But bear markets typically overshoot to the downside. If the KP ratio drops to 15, which happened in both 1982 and 2009, stocks could fall 62%, wiping out $31 trillion. The Dow Jones, currently around 44,000, could fall to 15,000 to 20,000. The S&P 500, at 6,000, could collapse to 2,000 to 2,500. The Nasdaq, the most overvalued index, could lose 70 to 80% of its value, taking all those AI and tech darlings down with it. This isn't speculation. It's math reverting to the mean. Real estate, $8 trillion loss. U.S. residential real estate is valued at approximately $47 trillion. In 2008, home prices fell 27% nationally, and as much as 50% in bubble markets like Phoenix, Las Vegas, and Miami. This time, with mortgage rates at 7% and the affordability crisis even worse. A 20 to 30% national decline erases $9 to $14 trillion in homeowner wealth. Commercial real estate faces even worse devastation. Office buildings could lose 50 to 60% of their value. Shopping malls and retail properties, already struggling with e-commerce competition, could lose 40%. Industrial properties might hold up better, but overall, commercial real estate could shed $2 trillion in value. Bonds, $5 trillion loss. Bond prices move inverse to interest rates. If the crisis forces the Fed to eventually raise rates to defend the dollar or combat inflation, or if the bond market simply panics and demands higher yields on government and corporate debt, existing bonds lose value. The U.S. bond market is worth about $50 trillion. A 10% average decline equals $5 trillion in losses for pension funds, insurance companies, and retirees. Cryptocurrency and other assets, $2 trillion. Crypto, currently valued around $3 trillion, could lose 70 to 80% in a liquidity crisis as people desperately sell anything for cash. Other alternative assets, private equity, venture capital, collectibles could lose $1 minus $2 trillion as the everything bubble deflates. Added together, $25 trillion in stocks, $10 trillion in real estate, $5 trillion in bonds, $2 trillion in other assets, and international markets losing proportional amounts. The total? Over $50 trillion in global wealth destruction. That's double the $25 trillion lost in 2008 and 10 times the inflation-adjusted loss from 1929. Chapter 5. When the dust settles, the crash itself happens quickly, a few months of violent selling and panic. But the aftermath? That determines whether we face a severe recession or a full-scale depression. And the evidence suggests 2026's aftermath could be far worse than what followed previous crashes. After 1929, it took 25 years for the stock market to recover to its previous peak. The Dow Jones didn't return to its September 1929 high until 1954. An entire generation of investors was wiped out and never returned to the market. Unemployment reached 25%. Banks failed by the thousands. The economic devastation lasted a decade. After 2008, recovery was faster but uneven. Stocks regained their peak by 2013, just 5 years later, but only because the Federal Reserve printed $4 trillion and held interest rates at zero for 7 years. Home prices took until 2016 to recover nationally, and millions of homeowners lost their properties to foreclosure. But 2026's aftermath faces structural problems that neither previous crisis confronted. First, demographics work against us. In 1929, America was young with high birth rates. In 2008, baby boomers were still working and saving. In 2026, baby boomers are retired and drawing down savings. A smaller working-age population must support a larger retired population while also recovering from the crash. Second, globalization means the crisis spreads faster and wider. In 1929, much of the world operated independently. In 2008, the crisis went global, but emerging markets like China could stimulate their way out. In 2026, China faces its own property bubble collapse. Europe struggles with energy costs and stagnant growth. And emerging markets are drowning in dollar-denominated debt they can't repay. There's no external growth engine to pull the world economy forward. Third, political and social instability could make everything worse. Both 1929 and 2008 eventually led to dramatic political changes, FDR's New Deal, and the rise of populism in the 1930s, and the Tea Party and Occupy movements after 2008. A $50 trillion wealth wipeout in 2026 could trigger far more severe political upheaval. Trade wars that become real wars, the breakdown of international cooperation, and domestic unrest that makes governance nearly impossible. The optimistic scenario? A severe recession lasting 2 to 3 years, unemployment hitting 12 to 15%, stocks recovering by 2030, and a slow, painful recovery by 2035. The pessimistic scenario? A decade-long depression, unemployment exceeding 20%, social instability, and a fundamental restructuring of the global economic system. Chapter 6. The Survival Blueprint. So what do you do with this information? How do you protect yourself and even position to profit when $50 trillion in wealth disappears? First, understand the phases of a crash. Phase 1 is denial, where we are right now. Markets hit new highs. Everyone says, this time is different. And warnings get dismissed as doom-mongering. This phase can last months or even a year or two. Don't panic, but do prepare. Phase 2 is recognition, usually triggered by an unexpected default, bank failure, or government crisis. Markets drop 10 to 15% quickly, then rally, then drop again. This is when everyone realizes the problem is real. Phase 3 is panic, when everyone tries to sell at once. This is where most wealth gets destroyed. Circuit breakers halt trading. Banks restrict withdrawals. Credit freezes. Phase 4 is capitulation, when even long-term investors give up and sell at the bottom. This is paradoxically the best buying opportunity, but it requires having cash and psychological strength when everything looks hopeless. Your defensive positioning strategy. Build cash reserves of 6 to 12 months of living expenses. Not in stocks, not in crypto and FDIC-insured bank accounts or money market funds. Cash is king during crashes because it gives you options and security. Reduce debt aggressively, especially variable rate debt like credit cards. Every dollar of debt you pay off is a guaranteed return equal to the interest rate. Paying off a 22% credit card is the same as earning 22% risk-free. Diversify away from overvalued assets. If your portfolio is 80% stocks, that's dangerous. Consider shifting some allocation to short-term treasury bonds, which are backed by the government and return 4 to 5% right now. Consider keeping 10 to 15% in physical gold, not gold stocks, but actual gold coins or bars. Protect your job security. In a recession, make yourself indispensable. Update your skills. Build relationships with decision makers. Have a backup plan. Your opportunistic positioning strategy. Keep a watch list of quality companies you'd love to own at the right price. When stocks fall 50%, companies like Microsoft, Berkshire Hathaway, and Costco that will survive and thrive become incredible bargains. But you need cash available to buy when everyone else is selling. Understand that the best investments of the next decade will be made in 2026 to 2027 when pessimism peaks. Every great fortune in America was built by buying assets during crashes. The Rockefellers in the 1930s, Warren Buffett in the 1970s and 2008, investors who bought real estate after 2008 at foreclosure prices. Finally, educate yourself continuously. The people who survive and thrive during crashes are the ones who understand what's happening while everyone else panics. The 2026 crash is coming. The math is undeniable. The debt is unsustainable. The valuations are insane. But crashes also create opportunities, the chance to buy assets at generational discounts, and position yourself for the recovery that eventually comes. The question isn't whether the crash happens. The question is, will you be ready? If stories like this, where we uncover the economic events that shaped our world while most people weren't paying attention, fascinate you, please like this video and subscribe to the channel, because we're just getting started with these financial, educational mysteries.